Hey, what is up, guys? It's been a while since we talked about what has been happening in the real estate market, so I think we should just jump right into it and see where the market's at and where it's going to be going in the future. So, Zillow home value appreciation goes into overdrive February 2021 market report. Before we start scrolling down and seeing what's happening in the future, I do want to highlight something. For sale inventory continued to fall, now down 30.3% year over year, so we are continuing to see that lag of inventory in the marketplace. If we scroll down to looking ahead, Zillow expects home values to grow to 11.4% through February 2022, an acceleration from the current annual pace of 9.9% and an upward revision from the prior annual forecast, driven in part by the re-acceleration of the Zillow Home Value Index growth. One thing I do want to highlight is that they said the annual pace of growth for last year was around 9.9%. This also coincides with other agencies such as the Federal Housing Finance Agency, CoreLogic, and Case-Shiller. They're all hovering around 10%, so it's pretty unanimous. Even though data varies a little bit, we're looking around 10% appreciation. Now, continuing with the article, by the end of 2021, we expect the U.S. Zillow Home Value Index to be 12.5% higher than it was in the end of 2020. So they're expecting things to be pretty bullish for the housing market. And what do other forecasters say? Well, overall, they're looking at an appreciative market at around 5.9% on average for appreciation for 2020. And one thing I do want to highlight here is that CoreLogic is at 3.3%. They're being pretty bullish. They tend to be pretty conservative on the way they view the market. And one of the things historically is that we usually tend to see around 3.65% as the historical average appreciation. Jumping on to the next article, because we did see so much appreciation in 2020, homeowner equity report came out for the fourth quarter. Homeowner equity increased by 16.2% or equivalent to $1.5 trillion, while negative equity was declined by 21% or $410,000. Basically, negative equity is when the home value drops more than what you owe on it, so the value has decreased significantly. In this case, because we've seen such an appreciative market throughout the U.S., things have been better for people who may be underwater at first. Jumping down, how's that appreciative growth in dollar terms per state? Well, according to them, the national homeowner equity in the fourth quarter of 2020, the average homeowner gained approximately $26,300 in equity during the past year. California, Idaho, and Washington experienced the largest average equities gains at $54,500, $48,500, and $47,200 respectively. North Dakota experienced the lowest average equity gain in the fourth quarter of 2020 at $7,900, and in my home state, you're looking around $12,000 as average equity gain. Not too shabby. Jumping on to the next article, trying to go through this data pretty quick. Where can potential first-time homebuyers find the largest supply of affordable homes? So we've been talking about the appreciation, and we have to discuss a little bit about fears that buyers may feel that things may be overvalued. So let's get into it. So I think this quote perfectly sets it. Affordability is better defined as the share of homes for sale that are within the renter's house buying power. Basically, according to them, renters' house buying power increased 10% compared to 1 year ago. Basically, the way they do is they typically, because first-time home buyers are renters, they use the median renter's income, assumed a 30-year fixed-rate mortgage, and made another assumption that 1/3 of first-time home buyers would be able to use their pre-tax income. I do want to add one thing. Lenders do have a lot of discretion about how they qualify people or whether they reject them. But in this case, they went ahead and used all this information, and then they compared it to sales data. Nationally, the house buying power of the median renter in the fourth quarter of 2020 jumped up 10% from $312,000 from $283,000 1 year before. The increase is primarily the result of a significant drop in mortgage rates to a record monthly average low of 2.7%. One thing I do want to specify, though, is that we are talking about buying power and the share of the market. Well, according to them, the share of homes for sale that the median renter could afford shrank nationally, falling to 57% in the fourth quarter of 2020, down from 61% a year ago. So we scroll down to 10 most affordable cities for first-time homebuyers. Nominal home prices vary dramatically by geography. So does household income, which creates regional differences in house buying power. The markets with the greatest house buying power are not necessarily the most affordable. Neither are the markets with the lowest nominal home prices. Affordable markets offer a sufficient share of homes for sale within the renter's house buying power. The larger the share of homes for sale that the renter can afford, the more affordable the market. And in this case, Austin, Texas is hovering probably around 40%. The market right now in Austin for the median price was around $395,000. That was actually due to the short month of February as well as the winter blizzard. Sales lagged a little bit because in January we're looking around $365,000 as the median price for Austin, Texas. They go on to say in this article, the most affordable city on the list is Oklahoma City, where the median renter could afford 86% of the homes for sale. In the fourth quarter of 2020, the median house price in Oklahoma was $184,000, and the median renter's house buying power was $329,000. So you're probably wondering to yourself, so house buying power is in a good setting, assuming that you have your job, and obviously there's going to be people who are at a loss and can't take advantage of the low mortgage rates. But are homes overvalued? Well, we can actually see the percentages. In 2005 fourth quarter, this was before the housing recession, you can actually see the regional areas. The Pacific was looking at 18.8% in the fourth quarter, Mountain area was 18.8% and 17.8%. The percentages were much higher compared to the fourth quarter of 2020, where we can actually do a comparison of the regional differences in appreciation compared to prior housing crash and in 2020, where people are assuming things are overpriced. The only reason we're seeing such a tight market is because of low mortgage rates, and that low mortgage rates spurred a lot of demand, and people are fearing of putting their house on the market, which because they're afraid that they can't find a home, and thus, since they're afraid they can't find a home, reduces inventory further. Moving on, mortgage rates. One thing I do want to touch here is because mortgage rates have slightly increased, about 32 basis points since January of 21st to March of 18th. We're looking at around 2.77% for the fixed rate mortgage, and now we're at 3.09%. And according to the chief economists of Freddie Mac and the chief economist of National Association of Realtors, it was expected to see a slight increase in interest rates. However, overall, they expect as things continue, the interest rate climb should be more muted, so we shouldn't see too much of an increase in mortgage rates. So overall, things are looking pretty good. Things are pretty bullish for the real estate market and a little bit more challenging for buyers, but it's not so challenging that they can't find a home. You just got to get a little more creative. And on top of that, if you're looking to buy a home, I highly recommend starting with the lender first and getting pre-approved, because the last thing you want to do is find a home that you want and not be able to take action. So on that note, I appreciate you guys. Peace out.